Hi, everybody. It's David Fleming here from the Toronto Realty Group, and welcome to yet another video with my mortgage broker, Tony Della. Sciucca. I don't know offhand, and to be honest, we probably spent 5 minutes to count. I think we've probably done 5, 6 of these. Feels like 2 a year, maybe since the pandemic when we started doing these. So thank you so much to the readers who proposed questions. I think we have 15 or 16 questions, although a couple are just comments, but I will ask Tony to comment on your non-specific question comments, because why not? So without further ado, because I feel like this is going to be very lengthy and it is a Sunday, Tony and I both have children. I like to hide from mine. Tony, I'm sure, would like to get back to his. So let's have a look. Tony, you there?
I'm here. Thanks for having me again, David. It's always a pleasure to be here.
Yeah. You do want to get back to the daughter.
On a Sunday.
I'm hiding here from my family. Okay. So, part of me is hoping this takes like 5 hours to.
It's all good. I'm honestly glad to be here and answer any questions and go through some of the posts. I do want to ask though, because I have been through some of the comments, I see a lot of familiar faces. Do you have a favorite like poster or a favorite
A commenter?
yeah.
Oh my God.
Because I see some familiar faces like Appraiser and Derek, and there's a few people out there. So do you have a favorite?
I think it's like asking somebody who's your favorite child.
That close?
I mean, like there's been so many over the years. So of the current readers, I would say, oh boy, I hope I don't hurt anyone's feelings. I would say, no, I don't have a favorite, but I would say like, okay, Appraiser, like tremendous commenter and contributor. Agree with everything because he's a market bull and he believes in building. Where we don't get along is he's a liberal, I'm a conservative. Although again, I would say that, when I was 20, I was a liberal. It just is, being a liberal back then means something different, just as a conservative. So anyways, not to make it about politics, but it's my fault. I always say things about Trudeau and he's like, well. I would say Ace Goodhart and I get along because we have the same view of the role of government or the overstepping of government, fiscal monetary policy. But Ace is currently bearish. So I'm bullish. So maybe not. So yes, I think Derek's awesome. I think I've exchanged a couple of emails with him over the years. Marina and Francesca, my mom called them the den mothers. She says they always post stories about like their own lives, and she's like, they could like supervise. They would be like the teachers at recess that rang the bell, right?
Sure. All right.
So I don't know. I mean, like, condo dwellers not around as much, but I remember Kyle and Chris, they used to be the guys that would go back and forth over and over. So, I mean, there's a lot of them, right? Like, Graham, right? He changed his name to the money because there's two Grahams. There's two Eds, there's two Peters, there's two Mikes. Anyway, so thanks for making me do that. So, okay, let me get to the questions. And now they're going to post and be like, I can't believe you didn't mention me. So a lot of questions here and pretty good ones. So Marina, okay, so the first one's Marina. When I edit this, I'll put it up on the, so of course she commented on Trudeau. Okay, says nobody's a Trudeau fan these days, and I don't care what the inflation rate is, he can't run anywhere. This is my mom being, she's the den mother. I genuinely believe no matter what happens in the next year, good or bad, the libs are out, the cons are in. I have this scary view of like the 1970s conservatives. I'd like to think they're not, anyways, topic for another day. Here are her questions, Tony. Okay. Can we get a more realistic view on buying with CMHC insurance versus without? Do you really get a lower rate with the insurance? I think this is such nonsense, but is there an optimal down payment? I've read some crazy takes and I'd like a balanced one, please. So she has two other questions, but let's just go to that first and maybe we'll get back to hers. So we do talk about this quite a bit. I think people are shocked to see that when they make a smaller down payment, they get a better rate. But can you explain why?
Yeah, so the way you want to think about this is, when you're borrowing money from an institution, when you put 20% down, institutions are balance sheet lenders, which means they're lending you their own money. And when you're putting less than 20% down, despite the fact that the money does come from the bank, the insurance companies protect the institutions in the event of defaults. So what the insurers do, CMHC, Genworth, and so on, is they incentivize, and the institutions incentivize those borrowers to get into those mortgages by offering lower rates. However, keep in mind that anytime you're putting less than 20% down on a home, you have to pay an insurance premium to get into that mortgage. Those insurance premium range anywhere from 2% all the way up to 4%, depending on how much you put down. So in spite of getting a lower rate, you have an insurance premium that gets tacked onto your mortgage that you have to now embed into the cost of your principal and interest payments. So part two of her question was, does it make sense? The short answer is, if you have the 20% to put down, you should do it. And if you don't, obviously you can't. But when you factor in the cost of the insurance premium relative to the lower interest rate that you're getting, you are not further ahead in the overall balance of the mortgage at time of maturity had you put down 20%. So the institutions, to some extent, are just making it easier for a consumer to get into those mortgages by offering lower rates for those who don't have the 20%. But the shorter answer is you're not saving any more money by putting less money down. It's actually costing you more money because you're embedding a premium back into the loan.
Yeah, unfortunately, there's people out there that think that it's unfair. Like, okay, I'm getting a 5.29% rate. I've got 20% down. Why is the guy that only has 5% down getting a 4.99? That doesn't make it. Well, okay, once you add in the CMHC premium, they're
It's
not
costing them more money. The aggregated rate is going to be higher than the 5.29 in your example that someone would be getting. So the benefit is that someone who unfortunately doesn't have 20% down has the ability to enter a market where, had it not been for these insurance premiums and lower rates, they would not be able to do so otherwise.
Okay, so then she says, is there an optimal down payment? I mean, I guess 20%, right? Like,
well, yeah, I mean, ideally, if you want to not pay the insurance premium, it's 20%. And at the end of the day, you're going to be able to put down, or you should put down, what you can afford.
Yeah.
And other than that, there really isn't a magic number out there. It's just really about, obviously, the more you put down, the less of a premium, and then at 20%, it gets fully waived.
So I'll add some color to this. I would say that when mortgage rates were at 1.69%, take the biggest mortgage you can take, right? Like, I'll be honest, Tony, I'll say, we bought our house in 2018. And we got a house, what was our rate? I don't know, 249. So I said, why am I going to have a larger down payment? And again, you can look at it and say, like, let's say I put my money out. What's the risk-free rate in the market? So let's say that, and again, everyone's different in terms of what acceptable rate there would be. But let's say you can put your money out at 6%. Okay. And let's say, I don't know where you are in the tax bracket, but let's say that 6%, you're 50% tax bracket. So you're making 3%. Why then, when the rate's at 249, would you not take a larger mortgage? And you can play around with these numbers. And so to Marina's question, I just wanted to add that if somebody has cash, it might make sense. You know, if you're going to go throw it on the roulette wheel or put it in Bitcoin, that's up to you. But the optimal down payment might depend on what's the current rate of interest, what's the rate of inflation, what's the risk-free rate right now. You know, are you Warren Buffett? Are you expecting to, you know, are you investing in CPP?
Some people are intrigued by, putting the money in the market. Some people simply want a lower monthly payment. So everyone's appetite is different, but ultimately at the end of the day, it's really your money, and you want to be able to, at least if you can, put 20% down to waive the insurance premium.
So next question, Marina asks, what are you seeing with refinancing? People want blood. There's another funny question here. What are you seeing with refinancing these days? Not just what people are doing in terms of fixed versus variable, but what's the reasoning and what's the fear level? That's like 4 questions, Marina.
Yeah. So again, the appetite for refinancing really depends on whether you're carrying other debts larger than the current interest rate of your mortgage. So in other words, if you have $20,000 of credit card debt, $20,000 of student line of credit debt, or whatever the case may be, obviously you want to refinance when the cost of borrowing back into your mortgage is cheaper than, what you're currently paying right now. So most people these days are trying to limit the amount of, refinancing their mortgage. In other words, if you have a rate of sub 3%, and you need to consolidate $30,000, $40,000, $50,000, most people are opting, and I'm encouraging them not to do it, because you would have to break your existing mortgage to inherit a new rate that would be north of 5%. So, you want to run sort of the numbers in terms of what it's costing you to currently break your existing mortgage relative to embedding the new debt back into the mortgage and paying those penalties. So we're not seeing too much refinancing these days unless it's 100, or absolutely necessary. But most people, I will tell them, if you have a rate that is sub 3%, to keep that mortgage intact and try to chip away at the debt. And when that mortgage comes up for renewal, you want to embed those debts back into the mortgage again. Okay,
good answer. Her third question, if you were to buy an investment property today, this is odd because I haven't heard from Marina. Let's say at the $750,000 to $900,000 range, what rate would you take and why? So I think she's saying variable versus fixed, because it's not like,
again, I think, most people, when they're buying investment properties, I think the best way to sort of, you want to see this is you want to be product sensitive first and then rate sensitive second. So most people will want to take a variable rate because it offers, a few different components that the fixed don't. One is you can convert that variable into a fixed at any given time. And then if you, God forbid, need to break that mortgage, you're only going to pay a 3-month interest penalty. And so when you take a fixed rate, you're sort of handcuffed for a longer period of time which you don't want. So as much as, you want to be rate sensitive, you want to be product sensitive first and then rate sensitive second. In terms of, what I would do is I think most people would want to take a variable rate with the anticipation that that rate will get cheaper over time. But a lot of this will strictly depend on what your cash flow is going to be at the end of the day, because interest rates right now, where fixed versus variables, your variable rate is almost, in today's market, 1% more expensive than a traditional fixed. So if you're buying an investment property and you have a shortfall, you need to be able to cover that shortfall to offset, the higher interest rate that you're getting. So the idea here is that at some point in time, the interest rate on the variable will begin to subside. When, we don't know. But the idea here is if you can save a little bit of money or have the foresight to want to save a little bit of money down the road, I would probably opt for a variable. Now, also, the discretion and the variances on those variable rates are getting a lot more appealing. So historically, traditionally, we were doing prime minus 40, prime minus 50. We're now seeing prime minus 90, prime minus 1%. So the discounts are getting deeper right now, which is sort of encouraging people to want to go back to variable rate mortgages.
Okay, and we'll come back to that because there's a couple other questions about it. So the next question is from Appraiser. I mean, I didn't want to talk politics, but he says, in Canada, we don't vote for prime minister. The over-reliance on charismatic politics is a weakness of our political and societal structure. I wish that was true, Appraiser. I think people do. I think that when Justin came along, you had Stephen Harper, who was like the old fuddy-duddy. And then you had this really cool, handsome, fun guy who, I'm not going to go on. I think that I wish that we voted for the policies. But I think that we do vote for the person. And if you look in the United States, I think they definitely vote for the person. His question, he says, and this is funny when he answers his own question, would you recommend going variable upon renewal? Or is this too obvious? I think that's his question. Is too obvious. We just kind of covered that, but tell Appraiser.
Yeah, I think it's a great question. The reason for that now is we weren't seeing the discounts that we're currently seeing right now on variable rates. So I'll give you an example. If a 5-year fix right now is 5.2 and a variable is 6.2, you're losing 100 basis points. So historically, you used to be inverted. You used to have a variable rate of, call it 4.5 and a fix of 5.5. In today's environment, that's sort of flipped the other way around. So what you're really anticipating is, do you think that within 5 years, your variable rate is going to be cheaper than the current fix that you're getting? And the consensus seems to be yes. And so what you want to do is sort of have the foresight to sort of bite the bullet on the rate right now in hopes that the Bank of Canada will drop the prime lending rate at least 200 basis points in the next 3 to 5 years, which I think is not unreasonable to think they will do so. So again, you need to be able to capture the savings on the variable side. Unfortunately, you have to take time within the next 3 to 5 years for that horizon to come to fruition. So to answer his question, I would certainly entertain a variable rate if I was getting something around prime minus 1 to prime minus 1/4.
So like most people, Tony's not going to get into your personal finance question and say, here's what you absolutely have to do. But I think you guys can read between the lines, and I'll get into when there's a question later. I did write a blog about my latest purchase, which we'll probably cover. So worth noting, just to respect one of the readers that responded to Appraiser who said, we don't vote for prime minister. And Steve said, we don't vote them in, but we sure vote them out. It's true. It always happens. Okay, so Mike says, this is what I was talking about, the blood. Mike says, I guess I like horror stories. What is the highest 5-year fixed rate you saw somebody take in the last couple of years? Do you know that offhand? Like, I'd be curious too.
So I can tell you, like, institutionally, so, one of the 5 major banks, at one point it was 589, 599, just a hair under 6%. Yeah. On the alternative side, they were mid sevens. And then, on the private side, they were close to 13, 14%. So, institutionally, institutionally, people were paying as high as 579 to 599 on 5-year fixed terms.
If you had people that said, I can't afford a 7% variable, give me a 5-year 599.
Yeah. The variables were really non-existent up until 2.5, 3 months ago, where we started seeing these deep discounts. But it's really hard for someone to want to take a shot at a variable rate when they have a fixed income and a fixed salary. And at that time, no one really knew if the variable rate would get more expensive. And I think for the first time, we're beginning to echo the sentiment that variable rates are going to get cheaper soon. We don't know when, but at least that's the consensus right now among most economists. And so everyone is just crossing their fingers and hoping that these rates come down eventually. But I think probably mid-year this year, we'll begin seeing these variable rates sort of taper down a bit. And I would expect probably in 25 basis points at a time.
So I love that you just said that, because the next question, I was going to add some color to Mike's comment, which I will. My first mortgage was 5-year at 4.99. And I've told the story a million times. My dad was like, take the 10-year at 6.99 and it'll never be cheaper. So the 5-year went up. So this was like 05, 06. The 5-year went up to 5.99. And a friend of mine, who shall remain nameless, the only guy I ever knew, the only client I ever knew that took a 5.99. And then, as we know, they came down. They've never been that high again. So I think that was 06 maybe. So we've gone, the 13. Yeah, we've gone 17 years not seeing that high. So you had a great lead into Anwar, regular name I've seen a lot in the last couple of years. Anwar says, should we ask Tony to join the interest rate prediction game? He has a huge advantage since we made our picks at the start of the year, but I'd like to know his thoughts. Maybe we consider it a more educated, more informed viewpoint. So Tony, at the beginning of the year, I posted on my blog and I said, here's our game. I think I said the winner gets a $200 Starbucks gift card. Can't remember. So we came up with 3 points, 3 questions, okay? The first one is, when is the first rate cut? Okay, which month? The second one is, how many basis points is the first rate cut? And the third question is, what is the total amount of basis points cut in the calendar year 2024? So would you like to, and when I edit this, I'll put up our game.
Sure.
So
I'll do it in 12 months and then I'll do 36 months just to kind of have a different horizon than everybody else. I think
okay.
12 months. Yeah. I think 12 months you'll probably see anywhere between 100 to 125 basis points.
You have to pick one. That's the game.
Okay. I'll say 100 basis points, 1%.
Okay, so
within 3,
okay.
And I think within 3 years you'll see 2.5% below where we are right now in 36 months.
Okay, but you got
that's my prediction. But in 12 months, I think we see at a minimum 4 rate cuts of a quarter each.
Okay, so when's the first rate cut? Is it March, April,
June.
May? It's June? Okay, and then the first rate cut is 25, 50, 75, 100?
25. I think you're going to see 4 consecutive rate cuts of potentially, I would say, a quarter point each.
Woo! Okay, so Tony's on the board. He has June.
By the way, am I part of this gift card as well? The Starbucks?
Actually, no, you're not a Starbucks guy. You're like you're like where you drink in a little cup. I picture you being an espresso guy. I've had espresso once in my life, and I thought I was going to die. I was like, "Who drinks this?" It was awful. But I picture you just being like a coffee connoisseur. I picture you waking up to roast your own beans.
Actually, I'm glad to say I have my own coffee bean. Well, I have an espresso machine that I'm loyal to. So unfortunately, I'm not a Starbucks guy. But I'm loyal to espresso, so no fancy coffees.
Roasting his own. I'm sitting here drinking this swill. Okay, so Tony's on the board. So June is the first cut. First cut, 25 points and 100 basis cuts. Okay, now Derek, your good buddy, he always says this. His first question is always, "How's business?" I don't know if it's like a polite kind of. So here we go. 4 questions. So we only had 16 people comment, but some people were asking like 5 questions. So he says, "How's business? Ratio of new buyers versus those refinancing is normal?" ? I think that's a question. He's saying, is the ratio of new buyers versus refinancing normal? So can you tell me of your business right now, what's the new versus refi?
Okay, so in terms of business, yeah, I would say it's very busy again, which sort of caught us off guard in the last, I would say, 8 to 6 weeks. It's been an influx of people looking to get back into the market. A lot of pre-approvals. People that were on the sidelines last year are now actively looking again. So I would say in the last 6 to 8 weeks, I would say an increase of like 60 to 70% in terms of business. So really busy. And the second part of his question is in terms of new buyers. Yeah, I would say for every 5 clients that I work with, 4 of them are new purchases and 1 would be like a refinance. Okay. So 20% I would say 20% of the clients now that I'm working with need to either refinance or transfer their existing mortgage, and the remaining are either looking to buy or looking to get pre-approved to purchase something.
So Derek's second question, and I knew someone would ask this. Lenders, so Derek's not asking it, this isn't Jeopardy. Lenders cautious about purchase price or not really? APS number getting lent without issue? I have to read it in a kind of colloquial way. So are appraisals coming in? Yes or
Yeah,
no?
yeah. I think we haven't had any issues on appraisals. So for the most part, appraisers are meeting their values. And you can attest to this. Is there was a point in time when, homes were being discounted. So we weren't seeing people overpay for properties, and on the listing agreements, normally we would see a house was listed at 1.5, we'd see 1.6, 1.7, 1.75, and now up until I would say 3-4 months ago, all the purchase and sale agreements that were coming in at either market price or just slightly under, and now we're beginning to see multiple offers again, offer dates, and things looks like overheating in terms of values coming in a little bit, or I guess I would say purchases coming in more than the listing price. So it's really hard to say what this market is going to bring, particularly this spring. But we are beginning to see a lot of new people back into the market. So what we're seeing is people that were on the sidelines last year are now back in, and then you're basically compounding that with people that are looking to buy. So you're almost doing like double the amount of work in 12 months.
Well, it's interesting because I'm not going to name the property, but I got a ridiculous offer on a listing, and the agent said, "This isn't going to appraise." And I was like, "Because the buyer agent told me that." I was like, "You're telling me this?" Like, "Don't worry, my client's got big down payment," and then they gave us a massive deposit check. But like, yeah, how's that going to appraise? So I actually said to this agent, "Wait 3 weeks until there are more crazy sales and comps, then have the appraisal done. Because then you've actually got comps."
And if I can add something on appraisals, just to touch on that, when someone is putting down 20% and the appraisal comes in light, you have to make up the shortfall, or at least 80% of that shortfall. When you're buying a property and you're putting 40, 50% down or 30% down, and that appraisal comes in slightly under list, in most cases, the banks don't care because you're putting so much of a down payment. So it only matters if you're putting 20% down or less and the appraisal comes in light. Particularly, it matters the most when you're buying something and you're putting less than 20% down, where you have to make up the difference. And that's hard to do for someone who doesn't have those funds. So when you're putting 25, 30, 35% down and the appraisal comes in slightly light, it's not a problem because the banks can offset that with the large down payment.
Last question from Derek. What normally happens with prices after a rate hike cycle reverses to lowering rates? Prices rocket, obviously. So, I mean, I think we've covered that. Yes, Derek, prices are going to skyrocket. Go out and buy.
Seems that way again. Yeah, I mean, it's not hard to, when interest rates are low, the values of home go up, and then conversely, the opposite happens. So when rates are higher, the values of the home seem to come down a touch.
Tough to be a bear right now. So here's an interesting question from Peter. He says two questions about the mortgage stress test. Did it work? I mean, as intended. The point of the stress test was to make sure people could afford payments when rates skyrocketed, and nobody thought that would happen, but then it did. Second question, any changes to the mortgage stress test on the horizon? Anything rumored or anything lobbied in the broker circle? He seems to think you guys have magic powers. So I do remember when the stress test came in. Now we're telling stories like back in my day, but back in the day, you qualified at 5% because the rate was 5%. Now you got to qualify at 7% because the rate's 5%. And that was pre-pandemic. Was that 2017, 18?
18.
So did it work? Can you answer that, Tony? Did it work as intended?
Yeah, I think they did a good job in taking a preventative measure in terms of making sure that people can afford higher interest rate movements. And it's done a wonderful job in terms of not only, the banks ensuring that people can qualify on these stress tests, but even as brokers, we want to make sure that we're encouraging people that in the event that you're purchasing a home, that you can afford the higher payments. And what we don't want to see is we're doing a disservice to clients by putting them in a mortgage where we know they can't afford to make those mortgage payments on. So I think the stress test did a really, really good job of not only putting a consumer in a position where they can afford higher payments or at least qualify for those higher payments, but also as brokers and individuals, it gives us the ability to ensure that people can afford the payments down the road. Because as you can see now, when you're at a rate of, and we're going to see this in 25 and the end of 24 is, if you had a rate of sub 3% at 199 or 2%, and now you've got to renew at 5.25%, your payment is going to go up nearly 40 to 60%. So we want to make sure that those people, those individuals are protected in being able to substantiate that higher payment. So, kudos to these individuals and OFSI for putting in these regulations to make sure that the stress test has been in place for a long time and it's been working. So I can honestly say they've done a good job with this. And to answer the second part is, I don't think they're going to make any changes to this. I know they've talked about it a few times. There's just no reason to do it. So I think it stays put for a while.
Okay. The next question is from Sarah. So I said I would come back to my experience. Sarah basically is asking, well, I'll read the question. Okay, so hi, Tony. Very exciting, exclamation mark. First time commenting on here. Of course, it's to you, not me. My question might ask you to predict the future, so I'm sorry in advance. Let's say a homebuyer isn't concerned with monthly cash flow and servicing monthly payments. Would it be prudent to take a variable rate today of like 6.5% and make those payments until a point in the future? What point is that and how long? What would be the signal locking in a 5-year fix? Thank you with an exclamation mark, Sarah. So we did cover that a little bit. So she's asking you to predict the future in saying what's going to happen with rates. But we did talk about this a little bit. And I think what Sarah's saying is, for the people that you mentioned that took a 5.99% 5-year fix because they couldn't afford the 7% variable, you said they're on fixed income and they're maxed out and they can't afford to play the game, so to speak. Sarah's saying, maybe if you're an investor and you want to take a variable now to lock in later, she said, would it be prudent? You've kind of answered that. And then she's saying, until a point in the future, what point is that and how long? What would be the signal, Tony, to lock into a 5-year fix?
So my thought process on something like this is, anytime you're taking a variable, and particularly now, is you need to be able to be saving at least 1% to 1.5% on the fixed side. And what you're basically saying is, if you're taking a variable rate now, is you're saying that within 5 years, you think that variable rate is going to be cheaper than the current fixed rate that you're getting now. So if you're able to absorb the higher payment for the next 12 or 18 or 24 months, then I think there's a logical reason for any individual to start taking a variable rate risk, because what we're predicting is that within 5 years, that variable rate may be somewhere between 3.5% to 4%, somewhere in that ballpark, rather than taking a fix in today's market at 5.25%. So the answer is, if you're not worried about the increased payment or cash flow, then I think you should really strongly consider taking a variable rate product. So that's number one. And then number two is, when you want to convert to a fixed, it's really a personal preference. I think personally, in today's world, if you're getting a fixed rate under 4% and you don't want to hedge any risk, I think that's a great deal. Obviously, those rates don't exist, but I would think personally, if you're getting something under 4% at no risk for 5 years, knowing what we've seen over the last 24 months, I think most people will become fixed rate converters before they start, entertaining variable rates again.
Okay.
And again, variable rates became very appealing when, someone was getting a fix at 199 and the variable was 125, right? So it almost enticed you to take the variable rate. But knowing what we know now and the number of increases that we saw in 18 months, I think the consumer today, in today's market, would say, I don't want to play that game anymore. I'm happy to take a 5-year fixed today, 499, 489, 44, whatever the number is, and not have to worry about the variable rate risk. And the variable rate risks also come with, like, their geopolitical concerns. There's so many conditions that impact variable rate increases. And if you don't have the stomach for it, it's very, very volatile. And so it's not for everybody.
So the point I was going to make was, I wrote on my blog. So Sarah's basically asking the question that I answered with, I bought this little condo and I wrote about it on my blog. I was like, basically, I tried to sell it to like 3 different people and it was too good a deal. So I was like, okay, I'll buy it. Sorry. I was like, I'll buy it myself. And so I took a 6.7% variable and I'm going to eat it. And I put all the numbers out there. It's like, this sucks. I'm losing what, $400 or $500 a month? Yeah, there's principal repayments and whatnot. But the point is, this is a 20-year hold, right? And so for me, when it hits 349, I'll lock in a 5-year fix. Now, when is that? It's not the end of this year, but I'd like to think within 12 to 18 months, and then I'm fine. 349, this thing would be cash flow positive. And then, as I wrote on my blog, once you factor in the principal repayment, it's like the 12% ROI.
I think it's fair to Yeah, I think it's fair to I think it's fair to say that we're probably not going to see rates sub 3% in a very, very long time. If in fact any time in the near future, I think you're probably going to see fixed rates at some point in time in the next 5 years, hopefully between 3.5 and 4.5%. But you're waiting at least, I think at least 3, 4 years. These rates right now are obviously people have come to grips with, being north of 5%. But I don't see them lasting that much longer above 5. I think we're slowly going to start seeing them creep down to under 4%, 5% in the next, I would think 3 to 6 months.
So Tony, I think we're about halfway through what I expect to be a very lengthy interview. Why don't we end it right here and we'll come back to this for the viewers on Thursday.
Sounds great.